a limit on the tax deductibility of corporate CEOs. And that limit was $1 million a year. So a business could deduct as a legitimate business expense only $1 million of the salary paid to its CEO. And people applauded. Well, that's fair, man. That punishes old companies. That is really good. That's how we're talking. All right, fine. So why don't we have income equality because of that now? Why are we talking about it? That was 1992, 92, 22 years ago. Why? Well, they did, but even so, why don't we have income equality? How come the CEOs are still, in fact, doing better than they were back then? Well, here's what happened. Have you ever heard of stock options? Have you heard of stock options? You have? Do you know how they came to be? It came to be right after Bill Clinton limited the tax deductibility of CEO salary to $1 million. Boards of directors still needed to hire the best people they could find. And when you're in the market for the best, it's going to cost you because everybody wants the best. Everybody serious about their business wants the best. If you are adjudged to be the best at what you do, there's going to be a lot of people pulling for you. So you need to be very creative as you offer work to the best. So these crafty chief financial officers came up with a trick. Stock option, the old stock option trick. They offered CEOs most of their compensation in stock options that would vest as the years went by and as the stock price went up. There was always that incentive. So the CEOs took very little of their compensation every year in salary, but then it was reported at the end of every year that they were earning 30 and 40 times, 50 times their salary with stock options, which were not subject to the law. So it didn't work. And we still don't have income equality. And we still have people like Harold Meyerson ticked off at how much CEOs make. So he's all happy that this California Senate committee's come up with a new way to make sure we spread the wealth. But it isn't going to work that way. What'll happen is exactly what happened in 1993. A company, a CEO, a board of directors, a CFO, whatever, will find a way to lower that ratio between the CEO's pay and the median worker's pay and still compensate the CEO at the same amount of money he was earning. They will find a way to do it. They'll find a way around Sarbanes-Oxley. They will find a way. That's what always... They find a way around wage and price controls. I love telling this story. Nixon placed wage and price controls on everybody during one of the oil shortages, 1972. And of course, companies gladly froze wages. If you go in and ask for a raise, I'm sorry, you know what? We really were thinking about giving you a raise, but our hands are tied. There's a federal law, and your salary is frozen. But you would go to the grocery store, and the prices didn't seem to be frozen. The prices were going up. So you go back to the boss, say, wait a minute, you told me that you really wanted to give me a raise, but you can't because the federal law says that wages and prices are frozen. That's right. We would love to give you a raise. We can't. Well, would you explain to me why the steak I wanted to buy at the grocery store costs more today than it did last week? No, I have no idea. I don't know. I'm not in charge of the grocery store. Well, what was happening was this. The butchers, the people that run the supermarkets just invented new cuts of beef, like the red eye B or the on-the-bone filet red eye cut 14, whatever, something that didn't exist that was not subject to any price control and charged to the nose for it, since they couldn't raise prices on anything else because the wage and price controls went into effect on existing goods and services. But all you needed was a new size of can of peas. Just a couple more ounces. You could charge whatever you wanted for it. A new cut of beef, a new mutton chop, whatever. There were ways around. It never works. Command and control never works. And this thing in California is not going to work. They're going to find a way around the ratio. And even if it did work, they are not going to make the ratio work by raising the median pay of the workers. They'll do it by playing games with what the CEO makes. Market forces are what they are. You pay people what you have to pay them. You're worth what somebody will pay you. It's that simple. That's why you have to make yourself really valuable to people. You make yourself indispensable as best you can. They're all excited. It's income inequality. That's part of the election vote turnout and promoting socialism, the government in charge of all this stuff. They're just excited. They can't see straight. But there never has been income equality. And by the way, the gap between the rich and the poor, if you want to say that it's growing, you have to make the point that the rich are getting richer under Obama. Far faster than they did under Bush. You got to ask yourself why.